I mean, I think what we're seeing, at least from an individual investor or retail perspective, is that there still is a lot of enthusiasm around the equity market in particular. We see that in retirement accounts when we're looking at it on a do-it-yourself basis. Then, of course, we have the anecdotes from the retail market more broadly. But I don't think that necessarily means that the general tone is speculative. I mean, when I talk to clients, there's still a sense of consternation, a sense of concern, whether it relates to AI, whether it relates to inflation, how the economy is actually trending. So I know we talk a lot about an AI bubble, but I'm not sure we necessarily see the speculative emotions that might go along with that, at least as it comes to the clients I speak with.
So we got this inflation print here this morning, Marta, and I guess a lot of folks, I mean, I think the way you were writing about it, is it a benign decline or a pressing concern? What is your takeaway after today's data?
I mean, can we do any better than Tom Keene's boring? I mean, it really kind of split the difference between inflation concern and what could be a less severe scenario. It keeps September in play. I think we don't exactly know how that's going to play out at this point, but I think at least from kind of the range of outcomes perspective, it keeps us away from a guaranteed hike at this point, and I think maybe the market can take some relief from that.
I should point out here, Paul, I say boring. Folks, it's showbiz, okay? Get over it. Marta knows, Eric Winograd knows, Dr. Sweeney knows our immense respect for how difficult this is, led, I would say, iconically by David Rosenberg. And the way he parses inflation. It's never boring. It just came out bingo on survey, a testament to all the economists.
They nailed it, Marta, what are we thinking here?
Economists have never felt so good,
Exactly. What are we thinking here in the bond market, Marta? Because we do have yields coming in, but they're still, higher than we've seen.
Yeah, I mean, I think the bond market is super fascinating when we take apart the pieces of what's driving the yield curve. I think it's a pretty interesting development that we've seen break-evens relatively constrained, which would suggest that inflation expectations remain anchored, even though we've had so much consternation print to print. And then the move in the real yields and parsing out what is driving that. And you look at the rising term premium, unevenly rising, but rising. You look at, uncertainty around the future path of rates that, we talk about September still being in play. And then you think about just kind of this general sense of fiscal concern and hyperscaler debt issuance. And it's just kind of a market where you wonder what could actually bring the yield curve down from here.
So it's interesting. One of the questions in the bond market is how much credit risk do you want to take? And I'm not sure there's a lot of incentive to do that.
Yeah, when I talked to our fixed income team at Empower, I mean, the big takeaway, and this has been kind of a status quo position, but the big takeaway is that you want to be judicious in the credit exposure that you have. We know that spreads aren't necessarily a timing indicator, but they certainly mean that people are getting less return for risk. And so I think there is a real carefulness on that perspective, just making sure that you're not overextending yourself.
There's still a lot of folks in cash, Marta. What's the conversation you have with them as you just think about markets and investing?
Yeah, I don't always represent the Wall Street view on cash. I certainly think that we want to be fully invested. There's a lot of value to putting your money to work, but I also think cash provides optionality, and optionality can be a really beautiful thing if you take advantage of it or put it to work at the right time. So when you do have a massive market sell-off and you have a little bit of cash on the sidelines, then you can, engage in the market at better prices. So I'm not always insisting that people put all their cash to work, especially when we think about retirees and the need for liquidity and surprise expenses. There's been some research around that and the importance of just having the ability to adjust to life's surprises. So certainly there's cash on the sidelines, but there's also a perspective that equity exposure is still pretty high.